Hi, this is Mark Santero with Homestead Advisors. And today I have the privilege of having Mauricio Agudelo, who is the head of fixed income at Homestead, and Jim Polk, the head of equities at Homestead. And today we're going to talk very timely about the Fed's rate cut of yesterday of 50 basis points. And there was a lot of different discussions on how much they were going to go. So I'm going to ask Mauricio to kick us off here. And Mauricio, what was your reaction to the more aggressive 50 basis point rate cut by the Fed?
Hi, Mark. Yeah. So on my end, I think the market was highly anticipating a cut, right? We were torn between 25 or 50 basis points. The majority of economists were actually forecasting 25 basis points. So the Fed did indeed surprise with the more aggressive 50 basis points cut. To me, what it signals is the Fed perhaps could have done a 25 basis points cut at the prior meeting. We know that they were late to the hiking cycle. And, we have seen signs of a softening jobs market. And perhaps this is a sign of the Fed saying, look, we're going to go big and go right now and make sure that we continue on track for the soft landing.
Interesting. Jim, any thoughts you have on yesterday's announcement?
Yeah, I didn't think it was a huge surprise. I think had they done it in July, 50 basis points, I think it would have freaked the markets out. I think people would have said, what is the Fed seeing that we're not seeing? Because the economic data is reasonably good. It's kind of normalizing. I think this was a very well telegraphed 50 basis point cut. It's been going on for several weeks. So I know there was a lot of debate around the 50 or 25, and is 50 signaling a weakening economy? We just don't see that.
Hmm. Well, so just Jim, to follow up on that, what is this? What is the 50 basis point cut, which was, Mauricio said economists had it at 25. The
Mhm.
market may have had it priced at 50. What does it say about the overall health of the US economy going to the more aggressive 50 basis points?
So if we think back a couple of years ago, the Fed was going through a massive hiking cycle where they were raising 50 to 75 basis points. That's not typical. And I
Hmm.
think trying to unwind that as they're trying to do, I think 25 basis points would have been perceived as maybe too iterative. And this, I think the narrative is certainly that the economy remains reasonably strong. Inflation is being tamed. It's not at the 2% level that they're looking for, but it's come down significantly. And this has provided some cover for the Fed to lower rates more than they would normally in a typical cycle.
Okay. Mauricio, do you agree with that? Or, what do you think it says about the US economy to take the more aggressive approach?
So I think the economy has shown signs of decelerating, but not at a critical pace. We have seen, as I mentioned before, jobs, the employment rate, had a cycle low of 3.4%, the unemployment rate. More recently, we are at 4.2. So we saw a steady climb in unemployment through 2023 into 2024. We have seen job openings declining, more towards, pre-pandemic type of levels. Jobless claims, they remain steady. They're holding steady. And so we have also seen job revisions, to
Hmm.
prior payrolls, coming lower. So the Fed at this point, what they're saying is, look, we got inflation down from the peak. We're now to a more manageable level of, say the mid twos, and they continue to see that tracking down to the, long-term goal of 2%. And they're saying, look, we're going to put the inflation discussion on the side right now. We're going to worry about the job market, and we're going to make sure that the economy continues to, to perform. And this small softening that we've seen in the job market, they are trying to tackle this, before it becomes a bigger issue down the road. And from a Fed fund standpoint, the rate stood at 5.25 to 5.5 was the range. The 2-year yield went all the way down to 360, 350, recently. So when you look at the differential between the Fed funds and what the Treasury market was pricing, yeah, there is a lot of room for the Fed to catch up.
And Mauricio, wouldn't you argue too? Sorry, but wouldn't you argue too that this is atypical in the sense of normally the economy is rolled over when the Fed starts an easing cycle, and that the fact that there's still strength in the economy is not a typical kind of raise and ease cycle for the Fed.
And most participants in the market are scratching their heads and saying, do they know something that we don't?
Right.
And the question always goes back to, is this time different? And look, it's a tough balance for the Fed to provide price stability and maintain long-term growth. And Chairman Powell said it yesterday. They are going to get down to a level where neutral is. We don't know where neutral is. We do know that Fed funds at 5.25, 5.5 for the current inflation picture. That was too high.
Mm-hmm.
Now, what is the neutral rate for Fed funds going forward? That remains, the question.
Well, I think a lot of that is going to have to deal with inflation, which is on everybody's mind. Which you mentioned jobs creation, job loss, wages. Are there any lingering concerns the Fed has in either their statements or market perception on the inflation front? Jim, any thoughts? And then I'll ask you, Mauricio.
Yeah, I mean, I think the Fed is still continuing to try and take inflation down to 2%. I think the stuff that we've heard from the last quarter and in talking with companies is that the supply chains, while not maybe 100% normal, are certainly back to a good place. And I think that was really a big part of the inflation picture over the last couple of years. So again, not perfect, but have certainly come down significantly, or have certainly improved significantly.
Mauricio, any lingering inflation concerns at the Fed?
I think one area where that can use some help is the housing market. We've had rates for mortgages very high levels for the past 10 years, and for all purposes the housing market has been frozen. What this could do is provide some flow in the housing market, and we need housing, and we need affordable housing, and that is a big component of expenses for consumers. So if we have some relief there, that will certainly help the Fed bring inflation down to that long-term 2% level.
Well, you mentioned housing, and obviously the mortgage market has been at high levels, and hopefully the cost of financing comes down, and we start to see home builders increase supply, whether it's for ownership or rental markets. So hopefully this has a ripple effect on housing. But Mauricio, I'm going to start with you and take a different turn here. So now that we've had the long anticipated pivot that we've all expected and came maybe a little later than what we thought at the beginning of the year. So what's the outlook for the U.S. investment grade market for fixed income? What does it look like for the rest of 24 and dare I say into 25? Knowing or not knowing, but given that we expect another 50 basis points in cuts this year, one in November, one in December, and as many as 100 basis points in 25. What does that mean for where we play U.S. investment grade markets?
Well, I think first you need to look at the shape of the yield curve. We are now seeing the steepening of the yield curve. We know that two stands were inverted for quite some time. We are now positive when you look at the 2-year Treasury yield versus the 10-year. We have seen more of the steepening post-Fed, and I still think we will continue to see that steepening. So from that standpoint, that is a good environment for front end 5 years and in, fixed income and those issuers of fixed income, those who rely on short duration, maturities. So that will be asset-backed securities, for example, come to mind, auto loans, consumer loans, where that 50 basis points from yesterday and was priced into the market, that will continue to help issuers and that will continue to get passed down to the consumer.
Mm-hmm.
Overall, the investment grade corporate market has been very healthy. We've had a very, very busy September in terms of issuance. We will expect issuance to continue to be robust for the balance of the year. That being said, from a total return standpoint, rates, yields, treasury yields have come down, and credit spreads are near the tights of the year. So therefore, that leaves you with just your coupon. It's really hard to see a lot of spread compression at this point for the balance of the year. And so your return is really going to come from that coupon, from the yield that you are earning. But as we've been saying now for this year, there is yield in fixed income. You have those coupons in fixed income that we didn't have before when the Fed was in the zero interest rate policy.
Right. So, the cost of financing is coming down, and historically, and again, historically, data points show that post a pivot by the Federal Reserve and with subsequent easing cycles, U.S. equities have performed, relatively well. Jim, what do you see in the U.S. equities market and the reaction with this pivot that we've experienced and pricing in the market for subsequent easing?
So again, I think this was well telegraphed. Easing, the market's held up well. Remember the early part of the year, it was a very narrow market with the Magnificent Seven, and that was sort of the narrative. And I think this was a positive for the market overall. Mauricio mentioned the curve steepening, so that helps financials, for example. And so we think you could see a broadening of the market, which I think would be really positive. It really does come down to if you believe the Fed is going to stick the landing, and we tend to be more optimistic that they have, or that they are certainly in the process, or that they're more conscious of it. Again, they're doing it at a time when the economy is reasonably strong. Yes, there's some pockets here, and we've heard about, from the banks, we've heard about credit normalization over the last several quarters. But this does offer relief to those consumers. This would be positive for home. This could be positive for home builders. The stocks, to some extent, have reflected that. They're up significantly over the last 12 months. But this has a longer duration to it if the Fed continues to sort of stay ahead of any weakening in the economy. So again, you have to kind of hope that they're sticking the landing from an economic standpoint, that they're not seeing something that nobody else is seeing, which I think is unlikely. And that this isn't 70s style, reinflation, and we just don't think that's the case. Like different dynamics, whether it's more productivity, more technology, we think it's less likely that you're going to see a big spike, 70s style spike in inflation. And so we're relatively bullish on the market, not only for the rest of the year, but into next year.
Well, thank you. I mean, that's encouraging to hear, based upon, previous easing cycles. So the last question I have is, you mentioned Chairman Powell and the fact that they, have we stuck the landing when it comes to bringing inflation under control without putting us in a recession? So Mauricio, I'll ask you first, parting thoughts. Are there any signs or do you fear any recessionary signals on the horizon?
At this point, the answer is no. I am paying close attention to the jobs market, and it really comes down to jobs, 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 and the quality of jobs out there. Things can change, right? I mean, it's really hard to say 6 months, 12 months from now, this discussion could be completely different. But where we are right now, what we see, we see a softening of the job market. How profound it becomes, I don't think it will. But we're always subject to outside shocks in the economy, and we live in a war where geopolitical events are always front and center. But credit where credit is due. What the Fed has done, they basically reloaded the gun. They got raised back up to a restrictive level. They have the powder now to cut rates if we were to go into some sort of recession crisis type of level. Same thing with the balance sheet. They committed to continue the quantitative tightening pace that they've been doing. So they have room. They will have room in the future, to address any issues.
Right. Jim, any parting thoughts on, do any sectors still vulnerable to potentially a recession, or, is this good news overall for U.S. companies?
I think it's good news overall for the economy. The consumer discretionary sector, of course, would be one that might stand out as vulnerable, depending on levered balance sheets at the consumer level. But we're not seeing that overall. Like, there are pockets of that, but overall, the consumer remains relatively healthy, and we're a consumer-driven economy. So we think that this is actually going to be a positive, kind of another boost in duration for the economy.
Great. Well, thank you both for sharing your thoughts post the pivot, as yesterday was known in financial terms. So we appreciate it, and thank you all for our shareholders and account holders in working with Homestead Advisors as your investment manager. Thank you very much, gentlemen.
Thank you.
Thank you.